Hey everybody, welcome to my channel. Hope you guys are all doing well today. In this video, we're going to be covering an on-chain options trading platform. To my knowledge, it's the first of its kind. It was essentially built by one female developer. It's an open source layer 1 platform, meaning that it's going to be highly composable with other DeFi projects. And in my judgment, it's going to be a pretty important Lego piece in the financial system that's being built on Ethereum. As more sophisticated market participants start diving into DeFi, I suspect a lot of them are going to be hedging their positions with options. And I could also see other platforms like Melon integrating this protocol, giving their fund managers the ability to leverage and also hedge against their position. If you wanted to have a dialogue about this project with like-minded individuals, I highly recommend that you guys check out my Discord channel. That Discord channel also gave birth to a subreddit. The tentative plan is to have weekly discussions on crypto finance. If any of that interests you, make sure you check out the links in the description below. Also, if you wanted to supplement and streamline your learning, consider checking out my weekly newsletter. It's a great way for you to track what's going on in the market, get introduced to new projects, and even get ahead of new trends. Unlike many tubers who recently made the shift to talking about DeFi, I was talking about DeFi in 2019, and many of the coins that have gone up 10x in the past few months were also featured in my newsletter. Again, all the relevant links are in the description below, so make sure to check that out. With that being said, let's go ahead and dive into this video. Alright, to begin this video, let's talk about what distinguishes Hegic from some of the traditional options that you guys have today. Some venues that people use today to trade Bitcoin and Ethereum options include Durbit, LedgerX, OKX, CME, and the general trend of the trading volume across all these venues has been going up all year. It's nothing compared to what you see in the legacy market with stocks, but in my view, that just demonstrates how early we are and how much room we have left to grow. Generally speaking, many developers, the community as a whole, has this proclivity towards decentralization. The irony here is obvious. Even though collectively speaking we value decentralization over centralization, most of the exchanges that we use, most of the platforms we use to get exposure to crypto are highly centralized. This includes all the venues used to trade options. They force you to give up money to a custodian, and they charge a lot of fees. There's maker-taker fees, delivery fees, withdrawal fees, and part of the reason why they have so many fees is because of operational expenses. They have to pay salaries to employees, they have to pay for real estate, they have to pay for their renting offices, infrastructure maintenance, and databases. Not only that, they require KYCs, and depending on which jurisdiction you live in, this might limit or prohibit your ability to access some of these services. And as users of the platform, there's very few ways for us to share in the success of the platform. Most of the profits are distributed to founders and small number of shareholders. That's a sharp contrast to what they're building in the decentralized finance world. They're building non-custodial open source on-chain protocols, and in the context of the Hegic protocol, they're only going to be charging taker fees. They're not going to have much overhead. It's going to be primarily funded through a community-driven funding process. And the highlight here is that no data is going to be collected from users. There's going to be no registration whatsoever. You don't have to put your email address or go through an extensive KYC process. 100% of the fees that are accumulated are going to be distributed to token holders who are participating in staking. In an effort to bootstrap liquidity and usage, early users who trade on the platform are going to be given Hegic tokens. It's essentially Hegic's version of liquidity mining. Another reason I was attracted to this protocol was because of the founder. It's an anonymous DeFi builder who goes by the name of Molly Wintermute. This also seems to be a general practice in the DeFi space. Many projects, many teams are opting to stay anonymous. And in my opinion, I think they're taking this route because they genuinely want to create decentralized permissionless protocols that are owned by the community. And for those protocols to remain censorship resistant, there can't be a central point of failure. This way, if there's any regulatory issues, any entity out there wants to shut down the protocol, they're unlikely to be successful if the protocol is sufficiently decentralized and organically run by the community, because in that setting, you can't go after a CEO, you can't go after a company to shut down the protocol. That effectively renders the protocol censorship resistant. Now, those are the reasons why I think having a pseudo anon developer could be a potential advantage in the long run, but I also like the founder's personality. If you guys are looking for character insights, I recommend reading this Defiant interview and also checking out the conversation on Discord. Molly occasionally comes in to address inquiries, and I like the fact that she's very straightforward. She has that I don't give a fuck type of personality. It may not appeal to everybody, but I appreciate the candidness. In addition to everything you guys see on Discord and you guys read in the DeFi interview. Also check out the Medium posts that she's published in the past. A lot of her thinking, her thought process, and personality is encapsulated in her writing. And you have to understand that this is a completely new way of starting a project, raising funds. Framework for analyzing and investing in projects like this hasn't been formalized or adopted by a lot of people. So if you guys wanted exposure to any of these DeFi protocols, you just really got to take a deep dive and come up with your own nuanced model for making assessments on DeFi protocols. And since this isn't going to be a comprehensive review, I haven't shared all my insights with you guys. If you guys want a better understanding of my framework, I'd recommend watching more of my videos, or you could streamline the entire process by joining my Patreon. All right, let's shift over to talking about tokenomics. The IBCO price for the token was approximately 13 cents, and since the IBCO, the price has stabilized around 6 cents, which means all market participants are down 50%. So in other words, if you just waited for the token to get listed instead of participating in the IBCO, you would have paid less per token. And before participating in the IBCO, I told all my patrons in my private Discord that I'm going to keep a little bit on the side just in case the price falls post IBCO. And given the price has now stabilized, I'm going to start accumulating more Hegic tokens around this zone. There's a good chance that I might sell off some of my uni tokens to purchase more Hegic tokens. The current circulating supply is approximately 90 million tokens with a market cap of 5 million. This only accounts for 3% of the total circulating supply. What we have to watch out for is this 20% that was allocated to early contributors. Even though I don't think it's ideal for them to have such a large percentage, I still view it as a fair distribution. I mean, these guys spent all their time and effort contributing to the protocol. If they're successful, they should be amply compensated. But the good thing is that these early contributors are vested for 24 months, and each month 25 million tokens are going to be unlocked for early contributors. In addition to that, 10% of the Hegic supply is subject to a 48-month-long vesting period. These funds are going to be used for long-term development of the protocol, which includes paying the future protocol devs and covering operational expenses. So as a whole, this is what you're looking at. 20% going to early contributors, 10% in the development fund, 40% for liquidity mining incentives, and about 3% that's going to go to people who participate in the IBCO. And the 25% allocated to the bonding curve is like a continuous token offering, and it's something I'll cover in a future video. Now, if you look at the fully diluted valuation, it's about 200 million. This in itself is very unattractive to VC investors, but what I think is a saving grace is the fact that to stake your tokens, you need at least 888,000 Hegic tokens. This will entitle you to settlement fees produced by the Hegic protocol. 100% of the settlement fees in ETH and WBTC generated by the protocol are going to be distributed among the staking lot holders. There's going to be a maximum of 3,000 staking lots, and that constitutes 88.5% of the total supply. And for you smaller Hegic holders out there, I wouldn't be surprised if sometime in the near future somebody creates a protocol to help pool Hegic tokens. So don't be disheartened if you don't have enough to stake. Assuming that the protocol works as expected, we get enough traction, because based on the demand out there, I believe there's definitely going to be some interest in using this protocol. We've already seen VC interest in the DeFi space, and this time around they're not just buying a stake in the company, they're actually buying some of the tokens. And since this protocol is going to be composable, there's a good chance that it's going to be integrated into other platforms, and those platforms might decide to get their own lots. This way they could monetize the volume that they bring to the Hegic protocol. Because if you just integrate the protocol, there's no way for you to share in the revenue that's made. The only way for you to share in the revenue is by buying the Hegic token yourself. Since the amount required to be a staker is so high, people who strongly believe in the protocol are going to have to get skin in the game. So in addition to creating a bid war, people will be incentivized to hold the tokens that they produce through these liquidity mining incentives. And it could potentially even lock in liquidity providers, options traders, because unlike other protocols where you don't really get any value in return for using the protocol aside from the profits that you might make, by committing to Hegic and not using any other protocol, they can accumulate Hegic tokens and potentially own a piece of the protocol. Now to end the video, I'm going to go ahead and share my thoughts with you guys. Obviously, I have exposure to the token. I'm planning to get even more. The biggest downside I see for the project is that they don't really have a formalized path to democratizing the protocol. I'm perfectly fine with a certain level of centralization early on, but eventually I want to see the protocol be fully autonomous and run by the community. I think two key features every DeFi protocol should strive to have is a plan to fully decentralize and have an autonomous protocol. And secondly, find a way to share the revenue with the token holders. Even though I didn't see it mentioned anywhere, I think eventually they'll probably head in that direction. The other thing I don't like is the massive circulating supply, but part of me feels like they could achieve the same objectives with a smaller amount of tokens. But outside of the criticisms I have, I really like what they're doing. I like the founder. After the protocol is fully audited and deployed, they're going to open source it, which will make it highly composable with other DeFi protocols. And based off what the founder said recently, it looks like other devs have started to build their own products on the Hegic protocol. And I also like the fact that they didn't spend any money on marketing the protocol. I didn't see any tuber or social media influencer shilling the IBCO. And even if you look at the Twitter profile, you can see that they're following 0 people, which is a positive sign. It shows that they're focused on development and delivering a working protocol. But I hope eventually a community forms, or they try to facilitate the formation of a community. But my hope is as the protocol becomes more popular, a community organically forms out of it, or they dedicate some time and resources to developing one. Because to raise awareness about the protocol, they get it integrated with other DeFi protocols or platforms and get developers to build on top of it, you're going to need to generate some awareness about the protocol. In my view, the best way to do this is by forming a loyal community. A robust and thriving community gives the protocol a huge microphone. By creating awareness for the protocol, you have a higher likelihood of attracting large and reputable players that could take your protocol to the next level. My views on how to analyze projects tend to be very nuanced, and rather than waiting for one of my videos you wanted to get real-time insights from me, I highly recommend that you guys check out my Patreon page. I have a lot of private resources that could streamline your learning of DeFi. The DeFi space as a whole moves very quickly. It can be very inundating to keep up with everything. By hiring me as your private analyst, I could save you hours of time by summarizing what I see happening in the DeFi space. If you guys feel like you could benefit from this service, I welcome you guys to join my Patreon by clicking the link in the description below. With that being said, this is CryptoOneStop signing out. I'll talk to you folks next time. Bye.